Portfolio Construction and Risk Management. Chapter 3, Asset Allocation. Section 1, Strategic Allocation. Strategic asset allocation is the long-term blueprint for how a portfolio should be divided across major asset classes. Instead of asking what the market might do this month, it asks what mix best fits the investor over many years. That usually means deciding how much belongs in stocks, bonds, cash, and sometimes real assets. The choice is shaped by goals, risk tolerance, time horizon, liquidity needs, and any outside constraints. In that sense, strategic allocation is less about prediction and more about design. It gives the investor a durable plan that can guide decisions through both good markets and bad ones. That long-term mix is often called the policy portfolio, and it acts like an anchor for the entire investment process. It sets target weights by asset class, such as 60% stocks and 40% bonds, and gives the investor a clear reference point. Day-to-day choices become easier because they are judged against an established policy rather than against emotions or headlines. It also makes performance evaluation more meaningful, since results can be compared with an appropriate benchmark. If the portfolio does well or poorly, the question becomes whether that outcome came from the policy itself or from implementation choices. A good policy portfolio keeps the focus on intention, not noise. Strategic and tactical allocation are related, but they are not the same thing. Strategic allocation is the long-term foundation, built to match the investor's plan across many years. Tactical allocation, by contrast, is a temporary shift away from that foundation because of a shorter-term opportunity or risk. The key idea is that the strategic mix stays in charge, while tactical moves are limited detours. Strategic allocation assumes that consistently timing markets is very difficult, so discipline matters more than constant prediction. That is why many successful investors spend more effort setting a sound policy than trying to guess every market turn. A suitable allocation begins with the investor, not with the market. Time horizon matters because money that can stay invested for decades can usually take more volatility than money needed soon. Return goals matter too, since a portfolio meant to fund major future spending may need more growth exposure than one built mainly for stability. Risk tolerance describes how much uncertainty an investor can emotionally handle, while risk capacity reflects how much risk their financial situation can actually support. Liquidity, taxes, and restrictions also shape the mix in practical ways. After that, the investor's needs are combined with realistic assumptions about expected return, volatility, and correlation across asset classes. Investor needs often matter more than chasing the highest possible return. A younger investor with a long horizon may be able to hold a stock-heavy allocation because short-term losses are less likely to disrupt the overall plan. Someone nearing retirement or expecting to spend from the portfolio soon usually needs more stability and more reliable access to cash. High liquidity needs also limit how much can be placed in assets that are hard to sell quickly. Most important, the best allocation is one the investor can actually stay with during stressful periods. A portfolio only works if it is realistic enough to hold through changing market conditions. Diversification improves a portfolio because risk depends not only on what you own, but also on how those holdings behave together. Too risky assets do not always create a riskier portfolio if they tend to respond differently to economic events. That is where correlation becomes important. When assets are not perfectly correlated, weakness in one part of the portfolio may be partly offset by strength or stability in another. Stocks and bonds often differ in how they react to growth, inflation, and market stress, which is one reason they are commonly paired. Diversification cannot eliminate losses, but it can help smooth the ride and reduce unnecessary concentration. In practice, strategic allocation is built through a structured process rather than a guess. The first step is defining objectives and constraints, including return goals, risk limits, time horizon, liquidity needs, taxes, and any restrictions. The second step is forming realistic capital market expectations for major asset classes, including expected return, volatility, and correlation. From there, different portfolio mixes can be compared to see how they might balance risk and return. The investor then chooses target weights that fit the plan, not just the most aggressive option on paper. Finally, the portfolio is implemented and maintained through monitoring and rebalancing. Even a well-designed allocation will not stay in place by itself. As markets move, asset weights drift away from target, and the portfolio can gradually become more or less risky than intended. Rebalancing brings the weights back toward their original targets and helps keep the risk profile aligned with the plan. That can be done on a schedule, such as once or twice a year, or when holdings move outside preset tolerance bands. In practical terms, rebalancing usually means trimming what has grown above target and adding to what has fallen below target. This process adds discipline by turning volatility into a reason to follow the plan instead of react emotionally. Luis's portfolio shows how drift happens in the real world. He began with a target allocation of 70% global equities, 25% government bonds, and 5% REITs, which on a 200,000 tower Brighty, which on a $200,000 portfolio meant 140,000 tinny REITs, 50,000 Dows and Downs, and AIN REITs. After a year of strong equity performance, the portfolio shifted to 75% equities, 22% bonds, and 3% REITs. Even if Luis did nothing, the portfolio became riskier because stocks had taken up more of the total. Rebalancing means trimming equities and adding back to bonds and REITs until the original 70 to 25-5 mix is restored. The plan did not change, only market prices did. Strategic allocation is powerful, but it always involves trade-offs. Higher expected return usually comes with higher volatility, while greater liquidity often means accepting lower return potential. That is why there is no one-size-fits-all allocation that works for every investor. Common mistakes include copying someone else's portfolio, using unrealistic return assumptions, ignoring liquidity needs, or confusing a long-term policy with a short-term market call. Another frequent error is focusing only on return and forgetting that staying invested through downturns is part of the real challenge. A sound allocation improves the odds of success, but it never guarantees results. Section 2. Tactical allocation. Strategic allocation gives a portfolio its long-term structure, while tactical allocation allows for limited short-term adjustments around that structure. The strategic mix is the blueprint built from goals, risk tolerance, and time horizon. A tactical move does not replace that blueprint. It simply leans the portfolio slightly in response to a specific opportunity or risk. For example, an investor might temporarily overweight bonds during unusual market stress or tilt toward a sector after a sharp but temporary dislocation. The important point is that the core portfolio remains the foundation. Tactical allocation works best as an overlay, not a redesign. What makes a move truly tactical is that it is specific, modest, and reversible. It should usually last weeks to months, not quietly become a permanent policy shift. There needs to be a clear catalyst, such as a valuation extreme, a central bank surprise, or an earnings reset that can be observed and reviewed later. Position size also matters, which is why tactical shifts are often kept in a limited range, like 5 to 15% of the portfolio. Just as important, there should be a defined path back to the strategic target. Without that exit plan, a tactical adjustment can easily turn into unplanned drift. Tactical allocation is often confused with market timing, but the difference is process. A disciplined tactical move is based on an identifiable catalyst, uses preset size limits, and includes clear conditions for exit. Broad market timing, by contrast, often relies on vague beliefs that markets are about to rise or fall, without rules for sizing or reversing the decision. The line between the two can become blurry if discipline disappears. That is why a formal process matters so much. Rules do not guarantee success, but they help keep tactical decisions grounded in evidence rather than emotion. A tactical shift should begin with a signal that is concrete enough to test later. Central bank decisions can matter because unexpected rate changes often alter the outlook for bonds, stocks, or specific sectors. Valuation extremes can matter when an asset becomes unusually expensive or unusually cheap compared with its own history. Earnings trends also matter, especially if revisions, guidance, or surprises point to a temporary disconnect between price and fundamentals. Market dislocations can create opportunities too, particularly when forced selling pushes prices away from underlying value. What does not count as a signal is a vague feeling that markets seem due for a move. A simple 5-step process can keep tactical decisions aligned with the long-term portfolio. First, define the catalyst clearly so you know exactly why the move is being considered. Second, set a deviation budget by deciding how large the shift can be and where the funding will come from. Third, execute the trade and document the reason, the size, and the date so the decision can be reviewed honestly later. Fourth, monitor the original thesis rather than watching prices emotionally. Fifth, exit systematically when the thesis plays out, expires, or breaks. Sizing is one of the most important controls in tactical allocation. The position should be meaningful enough to matter, but small enough that being wrong does not damage the overall plan. In many cases, that means keeping the core portfolio at roughly 85 to 95% of assets, and limiting the tactical sleeve to perhaps 5 to 15%. Funding often comes from cash, bonds, or another neutral holding, rather than from leverage or a complete portfolio overhaul. Setting limits before trading helps prevent conviction from turning into overconfidence. A good tactical idea should add flexibility, not dominate the portfolio. A simple example makes the math clear. Suppose an investor has a $500 portfolio with a strategic allocation of 60% stocks and 40% bonds. That means $300 is in stocks and $200 is in bonds. A 5% tactical overweight to stocks equals $25,000. So the investor sells $25,000 bonds and buys $25,000 stocks, perhaps through a technology ETF or another targeted exposure. After the shift, the portfolio becomes 65% stocks and 35% bonds. The strategic framework is still intact, but the investor has made a measured short-term tilt. The exit plan is what prevents a tactical idea from becoming accidental drift. A temporary overweight should end when the thesis succeeds, when the time window expires, or when new information proves the idea wrong. That can mean using a valuation target, a price recovery threshold, or a fixed deadline such as 6 months. It can also mean exiting early if the original catalyst changes in a way that weakens the case. Without a clear endpoint, investors are tempted to keep holding simply because they already made the move. Returning to the strategic target is part of the tactical decision, not an afterthought. Here is a worked example using round numbers. A 1 rels Muller portfolio has a strategic target of 70% stocks and 30% bonds. So it begins with 700,000 in stocks and 300,000 in bonds. If the investor wants a 5% tactical shift toward emerging market equities, that means moving $50,000. The investor sells $50,000 bonds and buys $50,000 of emerging market stocks. The result is a new mix of 75% stocks and 25% bonds, with that $50,000 tactical sleeve sitting inside the stock allocation. Because the trade is documented and sized in advance, it stays transparent and easier to evaluate later. Tactical allocation can add value, but it comes with several practical risks. The first is timing risk, because entering or exiting too early or too late can overwhelm a good thesis. Another is strategic drift, where a temporary tilt slowly becomes a permanent allocation without deliberate review. Position size is also a major issue, since a tactical move that is too large can distort the risk of the entire portfolio. Costs matter too, including taxes, trading spreads, and liquidity constraints that can eat away at a small expected edge. Perhaps the most common mistake is chasing recent performance without a clear catalyst at all. The main takeaway is that tactical allocation can complement a long-term portfolio when it remains measured, evidence-based, and temporary. It should sit on top of the strategic allocation, not replace it. Every move needs a clear catalyst, a defined risk budget, and an exit rule that is decided before emotions take over. Used this way, tactical allocation becomes a disciplined overlay rather than loose market timing. The goal is not to predict every market swing. The goal is to make selective adjustments without losing the structure of the larger plan. Section 3. Stocks versus bonds. Stocks and bonds are both core portfolio assets, but they represent very different kinds of claims. When you buy stock, you own a piece of a business, and your return depends on the company's growth, profitability, and market valuation. When you buy a bond, you are lending money to a company or government in exchange for interest payments and repayment of principal. Because of that difference, Stocks are usually used as the portfolio's growth engine, while bonds are often used for income and stability. Their legal position is different too, since bondholders generally have priority over stockholders if a company runs into trouble. Understanding those distinct roles helps explain why both belong in many portfolios. Stock returns come from two main sources. The first is price appreciation, which usually happens when a company grows its earnings or when investors become willing to pay more for those earnings. The second is dividends, which some companies pay out as a share of profits. Over long periods, stocks have offered strong growth potential because businesses can expand, innovate, and reinvest. But stock prices also move on expectations, not just current results, so short-term swings can be sharp. That is why owning stocks means accepting both opportunity and volatility. A bond creates returns in a more contractual way. The investor lends money to an issuer and, in exchange, receives coupon payments over time plus the return of principal at maturity. If you buy a $1,900,000 bond, for example, the issuer may pay regular interest and then repay the full $1,900,000 when the bond matures. Because those cash flows are defined in advance, bonds tend to be more income-oriented than stocks. High-quality bonds are often less volatile as well, especially over shorter periods. That said, bonds are not risk-free simply because the payment pattern is more predictable. The risks of stocks and bonds are different, which is why they need to be understood separately. Stocks face business risk, meaning the company may earn less than expected, and market risk, meaning investors may suddenly value the company less even if the business survives. Stockholders also stand behind creditors in the capital structure, so they are paid last if a company fails. Bonds, on the other hand, are especially exposed to interest rate risk because rising rates usually push bond prices down. They can also suffer from inflation risk, which erodes the value of fixed payments, and credit risk, which reflects the issuer's ability to repay. Neither asset class is free of risk. The risks just show up in different ways. Stocks and bonds often respond differently because they are driven by different economic forces. Stocks tend to benefit from stronger growth, rising sales, and improving profits, since those conditions support business earnings. Bonds can hold up better during slowdowns, especially when investors seek safety or when interest rates fall. High-quality bonds may even rise in value during stressful periods if money moves away from risky assets. Inflation and rate changes also affect bonds directly, while stocks are influenced more by how those conditions shape future profits. This difference in behavior is one of the main reasons investors combine them. Diversification between stocks and bonds comes from the fact that they do not always move together. Stocks usually provide higher growth potential, but they also come with larger and more frequent swings. Bonds generally offer lower expected return, yet they can help stabilize the portfolio and provide income. When both are held together, the overall result is often smoother than holding stocks alone. The exact balance depends on the investor's goals, time horizon, and tolerance for loss. In that way, diversification is not just about owning more assets, it is about combining assets that behave differently. A stock-bond portfolio will drift over time if one asset outperforms the other. Suppose an investor starts with a 70% stock and 30% bond allocation in a $100,000 portfolio. If stocks rise strongly while bonds lag, the mix might shift to roughly 74% stocks and 26% bonds after a year. Even if the investor made no new decision, the portfolio has become riskier because the stock share grew. Rebalancing means selling some stocks and buying bonds to restore the original target. This keeps the chosen risk level on track rather than letting markets decide it by default. Choosing a stock-bond mix starts with the investor's needs, not with the universal formula. A long time horizon can support a higher stock weight because there is more time to recover from downturns. An investor who needs income or expects withdrawals sooner may prefer more bonds for stability and cash flow. Shorter horizons generally call for less volatility, which often means a larger bond allocation. Risk tolerance matters too, because even a mathematically sound portfolio can fail if the investor cannot stick with it during declines. The right mix is the one that supports both the financial plan and the investor's behavior. Several mistakes can weaken an otherwise sensible stock-bond allocation. One is assuming that stocks and bonds will always offset each other, when in reality both can struggle at the same time, especially during rapid inflation or rate shocks. Another is performance chasing, where investors increase exposure to the recent winner just after much of the gain has already happened. It is also a mistake to treat all bonds as equally safe, since long duration or low quality bonds carry meaningful rate and credit risk. Inflation matters as well, because fixed income assets can lose purchasing power over time. And without rebalancing, even a good allocation can slowly drift away from its intended purpose. The practical takeaway is simple. Stocks and bonds do different jobs, and a thoughtful combination of both can make a portfolio more useful. Stocks offer stronger long-term growth potential, which helps with wealth building and keeping up with future needs. Bonds provide steadier income and often help reduce overall portfolio volatility. Both still carry important risks, so the goal is not to treat one as good and the other as bad. The goal is to choose a mix that matches the investor's horizon, spending needs, and tolerance for uncertainty. When the mix fits the plan, the portfolio becomes easier to hold and easier to manage. Section 4. Alternative assets. Alternative assets are investments that sit outside the traditional mix of stocks, bonds, and cash. This broad category can include real estate, commodities, private equity, hedge funds, infrastructure, and even things like collectibles or digital assets. What matters most is not the label, but the job the asset is expected to do inside the portfolio. Some alternatives are meant to diversify equity risk, some are used for income, and others are intended to respond differently to inflation or economic shocks. Because the category is so broad, alternatives should not be treated as one uniform bucket. Each type has its own behavior, risks, and implementation issues. Investors often use alternatives because some of them respond to different economic drivers than public stocks and bonds. If those return patterns are less correlated with the core portfolio, adding a small allocation may help smooth overall results. For example, real estate may be influenced by rents and property values, while commodities may react more directly to supply shocks or inflation. That difference can sometimes reduce overall portfolio volatility. But lower correlation does not automatically mean lower risk. Alternatives can still be volatile, hard to sell, expensive to own, or disappointing at the wrong time. Each major type of alternative asset has its own return engine. Real estate often earns returns from rental income and property appreciation. Commodities are driven more by inflation, supply and demand imbalances, and geopolitical events which can make them more volatile. Private equity aims to benefit from business growth and may also offer an illiquidity premium in exchange for tying up capital. Infrastructure investments often produce long-term cash flows from essential assets like utilities, pipelines, or transportation networks. Hedge funds vary widely, but their returns usually depend more on strategy skill, positioning, and sometimes leverage than on simple market exposure. Alternatives may offer benefits, but they also come with trade-offs that investors need to face honestly. Many are less liquid than public stocks or bonds, meaning they cannot be sold quickly without cost or delay. Fees are often higher as well, and those fees reduce the investor's net return even if the gross performance looks attractive. Private assets can be harder to value because prices are not updated continuously in open markets. Another issue is that diversification benefits may weaken in a crisis when many assets suddenly start moving together. Sometimes what looks like smooth performance is partly just stale pricing rather than truly lower risk. For most individual investors, alternatives are usually best treated as a satellite allocation, around a core of stocks and bonds. A common range might be roughly 5 to 20%, depending on the investor's goals, liquidity needs, and experience. Lower weights generally make more sense when flexibility is important, or when the investor is less familiar with the risks. Higher weights may be reasonable only if the investor has a long horizon, enough liquid reserves, and a strong understanding of the vehicles involved. Over-allocating to alternatives can make the portfolio harder to manage and harder to rebalance. The core should usually remain dominant. Before choosing any alternative investment, it is better to start with suitability rather than with product marketing. Ask how long the money can stay invested, and whether any of it might be needed in the next few years. Consider whether the existing stock and bond allocation already provides enough diversification for the investor's goals. Also, ask whether the investor can tolerate limited liquidity and valuations that may be less transparent or less frequent. Long-term capital is usually a much better fit for many alternatives than money needed soon. In other words, choose the fit first, and only then choose the vehicle. Even when two investments provide similar economic exposure, the vehicle used to hold that exposure can change the investor experience dramatically. A publicly traded REIT, for example, offers real estate exposure with daily liquidity, transparent pricing, and relatively low minimums. A private real estate partnership may offer different properties or strategies, but it usually comes with limited liquidity, higher minimums, layered fees, and more complex tax reporting. The same idea applies to commodity ETFs, private fund of funds, or direct ownership. Liquidity, transparency, fees, taxes, and operational complexity all matter. Choosing the right wrapper is often just as important as choosing the asset itself. Alternatives need an implementation and monitoring plan just like any other part of the portfolio. Before investing, the investor should understand lockups, redemption terms, notice periods, and how long a sale might realistically take. After investing, ongoing oversight should include watching fee drag, strategy changes, and whether the asset still behaves as expected in the portfolio. Liquidity mismatch is another risk, especially when an investment promises more flexibility than the underlying holdings can realistically support. Correlations can also change during market stress, so diversification assumptions should be reviewed over time. Planning the exit in advance is especially important when access to capital is limited. Maria's example shows how a modest alternative sleeve can be used without taking over the portfolio. In a $500 W00 portfolio, a 10% allocation means $50 W00 in alternatives and $450 W000s in traditional assets. She divides that 50 000 centin in a publicly traded REIT, 15,000 centin in a diversified commodity ETF, and 15,000 centin in a private infrastructure fund. The goal is to reduce dependence on a stock market while keeping some growth potential and inflation sensitivity. In a recession, these holdings may not all react the same way as stocks, so the combined effect can help cushion losses. The lesson is not that alternatives remove risk, but that different return patterns can broaden the portfolio. Several mistakes show up repeatedly when investors use alternatives. One is assuming that all alternatives hedge inflation, when in fact some do and some do not. Another is ignoring high management and performance fees, which can consume a meaningful share of returns. Investors also tend to overestimate diversification exactly when they want it most, even though correlations often rise during crises. Funding illiquid assets with money that may be needed soon is another serious mismatch. And as with other asset classes, chasing recent strong returns usually leads to poor decisions if the portfolio role is not clear. Section 5. Cash positioning. Cash belongs in a portfolio when it is held for a reason rather than by accident. Its first job is liquidity, giving the investor money for near-term needs without forcing the sale of long-term assets. Cash can also add short-term stability when markets are unsettled, because its value usually does not swing the way stocks often do. A third benefit is flexibility, since available cash can be deployed when attractive opportunities appear. The trade-off is that cash usually offers much lower long-term return potential than growth assets. So cash is useful, but only when its role is intentional. Cash can play three distinct roles, and it helps to define them separately. One role is as a liquidity buffer for emergencies or planned spending, which reduces the risk of forced selling. Another role is as a stability anchor inside the portfolio, helping soften overall swings. A third role is tactical dry powder, meaning cash that is available to invest after market dislocations or during rebalancing. These are not identical purposes, even though they all involve the same asset. Defining the role in advance helps prevent cash from becoming an unexamined leftover balance. Cash feels safe because its value is stable in the short run, but holding too much of it has a real long-term cost. Inflation slowly erodes purchasing power, so even positive nominal interest may not preserve real wealth. Over time, cash has usually trailed both stocks and bonds, which means a large cash balance can create noticeable cash drag. Even a small annual return gap compounds into a meaningful difference over many years. For example, if growth assets earn several percentage points more than cash each year, keeping too much idle can materially lower ending wealth. Stability is valuable, but it is not free. A good cash plan begins by separating emergency cash from portfolio cash. Emergency reserves should usually sit outside the investment portfolio because their job is to cover sudden needs such as bills, repairs, or temporary income loss. That money needs to be ready immediately and should not depend on market conditions. Portfolio cash serves a different purpose. It is part of the investment mix and may support allocation flexibility or rebalancing. If these two pools are blended together, the investor can end up misjudging both risk and liquidity. Keeping them separate helps protect long-term assets from forced sales during downturns. Once emergency reserves are in place, the investor can decide how much cash belongs inside the portfolio itself. For many investors, that amount may be modest, perhaps around 2 to 5%, especially when the horizon is long and liquidity needs are low. More conservative investors, or those expecting withdrawals sooner, may choose something closer to 5 to 10%. There is no single correct number because the target depends on risk tolerance, time horizon, and expected spending needs. Interest rates and market volatility can also affect how useful cash feels at a given time. The important point is to choose a target deliberately and review it when circumstances change. Choosing the right cash vehicle depends on what the cash is supposed to do. Money market funds are often useful when daily liquidity is the priority and the investor wants easy access with low volatility. Treasury bills can work well for very short-term holdings, especially when the goal is safety over a defined period. High-yield savings accounts are another option for accessible cash, particularly when the investor wants bank-based deposits and straightforward access. The best choice is not always the one with the highest yield. It is the one that matches the purpose of the cash while preserving the needed combination of access, safety, and simplicity. Cash can also make rebalancing easier and more disciplined. After a strong rally, trimming appreciated assets can naturally raise the cash position and create room to reset the portfolio toward target. After a decline, that cash can then be deployed into assets that have become cheaper. In this way, cash acts as a buffer between volatility and decision-making. It allows the investor to respond according to a process instead of according to fear or excitement. Used well, cash helps turn market swings into structured rebalancing opportunities. This example shows both the protective and flexible side of cash. In a $500,000 portfolio with a 4% cash target, the investor holds $20,000 in cash. If markets fall and the portfolio declines to $445,000, while the cash balance stays the same, cash rises to about 4 or 5% of the portfolio automatically. That slightly cushions the decline because the cash did not fall with equities. If the investor then deploys $5,000 into stocks at lower prices and the market later rebounds by 20%, that $5,000 becomes $6,000. Cash did not just reduce damage, it also created buying power when prices were lower. Most cash mistakes come from neglect or emotion rather than from deliberate planning. One common problem is holding too much cash for too long, which quietly reduces long-term growth. Another is failing to review the cash allocation as rates, needs, and market conditions change. Taxes on interest can matter too, especially in taxable accounts where cash returns may be lower after tax than they first appear. Some investors also rely on investments instead of maintaining a proper cash reserve, which can force sales during bad markets. And many people blur the line between emergency savings and portfolio cash, even though those roles should stay separate. This exercise brings the cash decision back to first principles. If a portfolio holds $20,300 in cash out of $1,000, the current cash weight is 2%. If the investor is considering raising cash from 3% to 10%, the real question is not only whether that feels safer, but what long-term return drag it may create. The added 7% held in cash needs to be compared with what that money might otherwise earn in higher return assets. Then the investor can weigh that cost against the benefits of comfort, liquidity, and flexibility. A smart recommendation depends on whether the larger cash position truly supports the plan or simply reflects recent fear.